Topic examines interest rate expectations and their influence on bond pricing, yield curves, and fixed income portfolio management. Interest rate expectations are fundamental because bond prices and yields reflect market participants' forecasts regarding future short-term interest rates, inflation, monetary policy, and economic growth. According to the expectations hypothesis, long-term interest rates represent averages of expected future short-term rates. When investors anticipate rising short-term rates, long-term yields generally increase as well. However, actual yield curves also incorporate risk premiums, liquidity preferences, and market segmentation effects. The program emphasizes that understanding interest rate expectations is essential for interpreting yield curve movements and managing interest rate risk effectively. The topic explains that the term structure of interest rates can take different shapes depending on market expectations and economic conditions. An upward-sloping yield curve often reflects expectations of economic expansion and rising interest rates, while an inverted yield curve may indicate expectations of economic slowdown or monetary easing. Flat or humped yield curves suggest uncertainty regarding future interest rate movements. The topic highlights that changes in expectations can significantly affect bond valuations because even small yield changes alter the present value of future cash flows. Consequently, portfolio managers closely monitor central bank policies, inflation expectations, and macroeconomic indicators when forecasting future yield curve behavior. Topic introduces the convexity effect, an important concept describing the curvature in the relationship between bond prices and yields. Duration measures the approximate linear sensitivity of bond prices to yield changes, but it becomes less accurate when interest rate movements are large. Convexity improves this approximation by accounting for the nonlinear price-yield relationship. Bonds with higher convexity experience larger price gains when yields decline and smaller price losses when yields rise, holding duration constant. The program emphasizes that convexity is generally beneficial to investors because it provides protection against large interest rate movements and enhances the accuracy of fixed income risk measurement. The topic also explains how bond returns can be decomposed into several components to better understand the drivers of fixed income performance. Total bond return typically consists of coupon income, reinvestment income, price appreciation or depreciation due to yield changes, and roll-down return associated with movement along the yield curve over time. Decomposition analysis allows portfolio managers to identify whether performance was driven primarily by carry income, interest rate forecasts, yield curve positioning, or active trading strategies. The topic stresses that understanding these components is essential for evaluating portfolio strategy effectiveness and managing exposure to changing market environments. Another important concept discussed is the interaction between duration and convexity in measuring interest rate risk. Duration alone may underestimate or overestimate price sensitivity for large yield movements because it assumes a linear relationship between bond prices and yields. Convexity corrects for this limitation by incorporating second-order effects into price estimates. Securities with embedded options, such as callable bonds and mortgage-backed securities, may exhibit negative convexity, meaning their price appreciation becomes limited when yields fall. The program highlights that convexity analysis is therefore critical for evaluating complex fixed income instruments and constructing portfolios resilient to volatile interest rate conditions. Overall, topics demonstrate that interest rate expectations, duration, convexity, and return decomposition are central components of fixed income analysis and risk management. Expectations regarding future rates shape the term structure and influence portfolio valuation, while convexity refines the measurement of interest rate sensitivity beyond simple duration analysis. Decomposing bond returns helps investors understand performance drivers and improve strategic decision-making under changing market conditions. The program emphasizes that successful fixed income management requires integrating macroeconomic expectations, yield curve analysis, and advanced risk measurement techniques to manage portfolio exposures effectively in dynamic interest rate environments.